Okay, hi there and welcome to a macro video. In several advanced countries, the risk of a recession in 2020 has increased in recent months. So in this short topic video, we're going to revise the key policy tools and instruments that might be used to prevent a recession. So here we have a newspaper article, the Bank of England, in a recent macroeconomic forecast saying that the chances of recession in 2020 in the UK are 1 in 3. Of course, a recession is defined as when the economy contracts. In other words, there's negative growth of real GDP for 2 consecutive quarters, 6 months. And there are risks of a broader downturn in the world economy, a slowdown in global growth, which might of course be a negative external shock for the UK. Recessions are rarely the result of one single event. So thinking ahead to 2020, the UK might have to weather some of the potential fallout from the Chinese-US trade war, a continued Brexit uncertainty, forecasts by some people of a drop in average house prices, and also, critically, significantly, a downturn, a possible recession in Germany, which is Europe's biggest economy. Here's a quote from the Bank of England in their November 2019 inflation report. Underlying growth in the UK slowed last year, or back end of this year, as weaker global growth and Brexit-related uncertainties weighed on spending. Weaker growth of the world economy, partly driven by trade protectionism and the associated rise in uncertainty. This is the backstory, this, if you like, the backdrop to where we're heading into 2020. And this is the Bank of England's fan chart projection for real GDP growth. The darker the green area, the more central this forecast is to their overall forecast. They're not thinking there is going to be a recession, but you can see at the outer edges of the projection, there is a potential risk of a downturn in GDP in the next year or two. Thinking just a little bit about supply and demand analysis at the macro level, recessions are nearly always caused by an inward shift of aggregate demand. They can also be caused by a fall in aggregate supply, but typically most output-based recessions are triggered by a reduction in confidence, in demand, leading to a contraction in production. So what are the main policy instruments? What are the main macroeconomic options that might be available to the Bank of England and also to the UK government when faced with a genuine risk of a downturn? Well, 3 things on the monetary policy side spring to mind. One is the opportunity, the option to make a cut in base interest rates. The second one would be to expand the scale of asset purchases through what's called quantitative easing. And in theory, the Bank of England could intervene to achieve a currency depreciation by going into the foreign exchange markets. That's monetary policy. What about fiscal policy? Well, lots of options here. One would be to cut the burden of direct tax, for example, income tax or national insurance paid by both employees and employers. They might also reduce the burden of indirect taxes, perhaps a cut here in the standard rate of VAT. They could also increase their own government spending, a sort of fiscal stimulus by adding to planned departmental spending in areas such as transport, education, health, defence and the environment. So lots of options on the fiscal policy side, most of which would involve, in the short term at least, an increase in the level of the budget deficit. Trade policy is also important. It's rarely mentioned by students, which is slightly surprising, but certainly a more favourable trade environment, for example, progress in 2020 towards agreeing a full trade agreement with the EU, would help to mitigate some of the downside risks facing the UK at the moment. So those are the main policy options in my view. What about the current situation? Well, base interest rates are 0.75%. They've remained, of course, below 1% for the best part of 10 years now. So is there much scope for the Bank of England to cut interest rates? Would the bank consider the possibility of moving, as some countries have done, towards negative interest rates? Quantitative easing currently stands at £435 billion. Is there scope for increasing that towards £500 billion? Could there be a change in the nature of QE. Some people are putting forward the idea of green QE. In other words, the Bank of England buying bonds specifically issued to fund environmental clean energy investments. On the exchange rate intervention, well, the UK has for the last 27 years operated with a free floating exchange rate system. The Bank of England knows that their policies do impact the exchange rate, but they don't intervene directly in the currency market, and I cannot see that changing. What about direct taxes? Well, is there a scope for a modest tax cut, a cut in the basic rate of income tax from 20%, or perhaps increasing the tax-free allowance, the amount you could earn before you start paying tax beyond £12,500 a year? If there's a recession risk, would a cut in VAT, perhaps a temporary reduction in VAT to, let's say, 15%, could that stimulate consumer spending? I think what we're seeing, if you're following the general election campaign closely, is that certainly the two main political parties, Labour and the Conservatives, all seem to be trying to outdo each other with promises of big hikes in state spending and investment and an end, in inverted commas, to fiscal austerity. Very interesting tweet by Linda Yu, the great expert on China, just a couple of days ago. She was reading some economic research and found that during the last 40 years, that takes us back, of course, to the late 1970s, central banks in the leading advanced countries, such as the United States Fed, the European Central Bank, Bank of Japan, have usually cut interest rates by around 4% in response to recessions. That happened in the UK in 2008-2009. But of course, with nominal interest rates in the UK at 0.75% at present, the scope for cutting interest rates simply does not exist. Will negative interest rates even come into the equation? We wait to find out. Keynesians argue that if there is a risk of recession, if there is the risk of a semi-permanent deflationary downturn, then the government and or the central bank should be proactive in introducing stimulus policies, counter-cyclical macro policies. If the private sector is spending less, C plus I plus X as part of AD, then there's a case, according to Keynesians, for active use of policy to stabilise confidence, animal spirits, and hence demand. But of course, there's an intense debate in economics about which policy options would be most effective, short-term, medium-term, in stabilising confidence and spending. And of course, much depends on what's actually going to be causing the recession. Is it a recession built at home, collapse in house prices, for example, or is it a recession which is largely the result of external factors over which the UK may have little or no control? And the risk of avoiding recession is also dampened a little bit by having automatic stabilisers in place, allowing welfare benefits to rise, for example, perhaps encouraging the floating exchange rate to depreciate. These help to stabilise the economic cycle during a downturn. So can a recession be avoided? Well, the interconnected nature of the world economy with global value chains and lots of different components and different products mean that a shock in one part of the world can have a significant reverberation effect in many countries. It can make recession avoiding policies difficult to implement. The UK is an open economy and it is susceptible to the issues we've mentioned at the start: trade protectionism, China slowing down, Germany in recession, and so on. We can't ignore or be immune to those forces. Secondly, policy interest rates in the UK remain at historic lows. There is simply less scope to cut them in the event of a downturn. Equally, on the fiscal side, although the government has a budget deficit 10 years after the last recession, the yield, the interest rate, if you like, on government bonds is extremely low, and perhaps that is giving scope for an increase in public sector or state investment and associated borrowing. Fundamentally, if you can get your supply side right, if you can increase productivity and diversify your economy, get the regional economies becoming more successful, that in the long term makes any economy more resilient to external economic shocks. So there we go, an overview of some of the key macro policies that might be used to avoid an economic recession.